What's up guys, Ben here, welcome to my channel. So you want some information about a VA loan. Well, in this video, we're gonna give you exactly that. I'm gonna go through what a VA loan is, who can get a VA loan or who qualifies for a VA loan, and how to get a VA loan. I'm gonna go through some of the income and the document requirements that you're gonna wanna look out for, as well as some money saving tips that you can talk to your lender about. So let's jump into it. But first guys, I'm a lender, but I am not your lender. And while this video is gonna give you some useful information and some things to look out for, I'm not going over your specific goals or your specific situation with you. And so you're going to want to contact a lender. I typically recommend at least 30, 60, or 90 days before you actually look for your home or start looking for your home. The last thing that you want to do is to find your dream home or that rental property that's going to help you start that multi-million-dollar rental empire. And then you find out later on or later in the process that you don't qualify for the home at all. So you want to do whatever you can to avoid that, and contacting a local lender is going to be able to help you bypass some of those roadblocks that you might meet. All right, so let's start with the basics. What is a VA loan? A VA loan is a veteran loan used to buy a primary residence. Now, you can use VA loans to get a piece of rental property, but there's a few tips and tricks that you have to use. They're perfectly legal, perfectly fine, but you can't just go to a lender and say, I want to buy a rental property with my VA loan. But a VA loan is a benefit to veterans and certain qualified spouses. Today, I'm mostly going to talk about the veteran status, but I'll have some links and some other information about VA loans and how you can qualify as a spouse down in the description below. VA loans are backed by the United States Department of Veteran Affairs, and that means that there are some very strict and specific guidelines that are set to help protect you as a veteran, but that also means that there are some very strict and specific guidelines that you need to meet in order to qualify for a VA loan. So let's jump into those. All right, so now that you know what a VA loan is, let's go through who can qualify for one. As I said before, it'd be veterans and qualified spouses, but it can also be active duty and National Guard or reservists. As a slight side note, you're going to want to get a copy of your DD-214 or your certificate of eligibility. This is going to tell you and your lender how much your entitlement amount is and if you actually qualify for a VA loan. I have, again, links in the description down below that tell you or walk you through how you can request a copy of these. You're going to want to have those handy before you start a mortgage process because they can take a couple weeks to get, and you don't want to be in the middle of the mortgage process and find out that you have to wait 2 weeks to close because you don't have these. And if you get them and they say that you don't qualify, then that's going to blow up your whole loan. And so you want to make sure that you at least have these requested or have these available to you before you actually apply for a mortgage. Okay, so let's say you're ready to contact your lender and get pre-qualified for a VA loan. You can absolutely do that. But this section is going to give you some tools in your toolbox, some things to look out for, some questions to ask, so you know what to expect before you contact your lender or while contacting your lender. So let's talk specifics. A VA loan is a 15 or 30-year mortgage. You want to make sure that it's a fixed rate mortgage, which means that the rate doesn't change for the life of the loan. You don't want to get 10, 15, 20 years down the line and have your interest rate change and then have it be a payment that you can't afford. You want to be able to lock in your monthly payment, aside from, say, taxes and insurance changing over time. You want to be able to lock in your principal and interest rate, and then that way it's going to have a more stable monthly payment for you. By the way, in this market, that applies to all mortgages, whether it's FHA, VA, or conventional. You kind of want to get a fixed rate rather than an adjustable rate because the rates are so low right now, they're more likely to go up than they are to go down. So VA loans don't actually require anything down, but zero down doesn't mean zero cost. There are still things like closing costs and prepaids, which are prepaying taxes and insurance. These things are due at closing and they can cost thousands of dollars. So you want to be prepared for that when you go to a lender and they say, oh, it's zero down, but then you get a quote and there's like $3,000 worth of other costs. I'm going to give you some tips or some information on how you can truly get a VA loan with nothing out of pocket. We'll talk about that in just 1 second, but I wanted to break down what some of these costs are, like what closing costs are, what prepaids are, and then there's something called the VA funding fee, which is something that you really want to look out for because this could make or break whether or not a VA loan is going to be the right loan for you. And we'll talk about all that in just 1 second. All right, so closing costs. Closing costs are the fees that a lender, a title company, and an attorney will charge to make sure that the loan is set up properly and to make sure that at closing you are now the legal owner on title. It helps prevent like any lien holders or any previous lien holders or anyone that may have had a say in ownership of the property, and make sure that you're getting a clear title so that none of those parties could come back on you at a later date and say that you're now not somehow the legal owner. This stuff is kind of rare, but it does happen from time to time. And so the title companies and that charge a fee to make sure that you have clear title and to facilitate your closing. Now, with that said, these fees can range anywhere from $2,000 to $10,000 or more, depending on the price of your home. And so I generally recommend that you do the rule of 3 here. And that is you contact 3 people to get different quotes. So maybe talk to your realtor to see if there's anyone that they work with, like any trusted lenders that they could recommend. And then contact maybe one of the big box or the online mortgage brokers. And then maybe go to a local bank or credit union to get 3 quotes that you can compare side by side, because not all of these are created equal. Having 3 different quotes are going to obviously allow you to compare costs and rate. Some lenders are probably going to have higher closing costs but lower rate. Some are going to have lower closing costs but higher rate. It's going to allow you to see if you're paying anything to get a lower rate above the closing costs. And there's another little secret that most lenders don't talk about, and that is you can use those quotes to compete the lenders against each other. Most lenders have a policy where they will price match to a certain extent, but they won't do it obviously unless you ask for it, and most people don't know to ask. So let's say you get your 3 quotes and one of them has pretty low closing costs, but you're not really fond of the rate. And another one has high closing costs, but the rate is pretty good. You could ask the lender with the lower closing costs if they will match or what they could do to match that interest rate. And again, most of them will do something to accommodate you, or at least tell you, oh, we could be in the ballpark. But again, it's something that you have to ask for. They're not just going to do it for you. So negotiating a lower interest rate just by asking one of the lenders to price match doesn't cost you anything. And it's a very common practice, but again, you have to ask for it. And it could potentially save you thousands of dollars over the life of the loan. The next cost is going to be what we call prepaids. Prepaids are due at closing, and they are your prepaid taxes and insurance. We collect a little bit up front. It's usually a prorated amount depending on when the tax bill's due. But we collect that up front to make sure that next year you have enough in your escrow account to pay the next year's tax or insurance bill. Each monthly payment that you make will have a little bit of your of the monthly payment come out for taxes and insurance, and it'll also go into that escrow account. Doing this ensures that you have enough in that escrow account to pay your next year's taxes and insurance. This is going to prevent you from coming out of pocket to pay a big tax bill or a big insurance bill should they come due next year. And it's also going to prevent you having to come out of pocket, say, if your taxes or insurance raise from year to year, and they typically do. So there's going to be a little bit of buffer in your escrow account that allow the lender to pay the taxes and insurance for you, and you not have to have an unexpected bill. And again, depending on where you live or depending on the amount of the cost of your house, your taxes and insurance can be thousands of dollars. This is going to help prevent any unexpected fees later on in the year that you might not have saved up for. So now, this isn't a fee, but it's a little tip that you can do. I typically recommend you talk to your realtor about it first. But on a VA loan, you can have the seller of the property pay 4% of the purchase price towards your closing cost or your prepaid items. And that's how you get a zero down, zero cost VA loan, is you can negotiate that the sellers will pay some of those costs. Now, one of the other things is the sellers can also put some of that 4% to buy down your interest rate, meaning some of the seller fees, let's say you buy a $200,000 house, the sellers could pay 4% of that, and some of that could go towards your interest rate or towards you getting a lower interest rate, which can help save thousands of dollars over the life of your loan, depending on your loan amount. Again, this is something that you have to negotiate it in a contract. So you want to talk to your realtor about it first, because it might not be good for you to do. Some sellers are kind of weird about it. And so it's something that you want to bring up. They might, again, immediately turn you down, but you could at least try to ask for it. And you kind of want to bring that up to your lender to say, hey, if you negotiate the 4% seller pays and you have any remaining, could we use that to pay for a lesser interest rate. Now, the final fee is the funding fee. Guys, this is the single biggest fee that you want to look out for, and it's the one thing that can help make or break whether having a VA loan is going to be the loan for you. But first, guys, if you like what we're doing, please consider liking and subscribing. I don't just talk about mortgages. I also talk about improving our overall financial health through like personal finance, investing, real estate, building our income, building credit. And so if you like what we're doing, please hit that little red button. It helps the YouTube algorithm show my content to more people. And so if you like what we're doing, please consider subscribing. All right, so now that my pitch is over, let's talk about the VA funding fee. Again, the VA funding fee is one of the single biggest fees in a VA loan, and it can often make the loan not worth having. And so it's something that you really want to look out for. If you're putting less than 5% down, the VA funding fee can be 2.3% of the mortgage. So the average home in America is about $250,000. 2.3% of that is about $5,700. Now, this can be financed into the mortgage, or it's going to have to be paid out of pocket, or the lender is going to increase your interest rate on you, and they kind of bury that fee in the interest rate. And so it's something that you have to look out for. Now, if you finance it in, that's perfectly fine, but it's still something that you have to pay over time, obviously. And so looking into other loan options might be more beneficial, especially if you have a down payment. Now, if you're putting 5 to 10% down, the fee drops to 1.65%. And so on, again, $250,000, that's going to be about $4,100. And so again, it can be financed in, but it's an added fee that you want to look out for. So I recommend that if you're planning to put 3 or 5% down, and again, if you don't have that, that's perfectly fine. The VA loan has 0 down. But if you're putting 3 to 5% down, or if you're putting 20% down, you have to look at conventional mortgages. The closing costs are going to be a little bit less, and they don't have that funding fee. If you're not putting 20% down, though, you're going to have what's called monthly mortgage insurance. VA loans don't have this, and it's usually about $75 per month per $100,000 you borrow. And so you gotta weigh it out, or have your lender look at it for you to determine whether or not getting a conventional loan is cheaper, because it may be, depending on the price of your home, 2.3% of the price of the mortgage on a funding fee is pretty high. And so there are certain instances where doing a conventional mortgage is going to be better than doing a VA mortgage. Now, a little tip, the funding fee can be waived if you're a disabled veteran, or if you're a surviving spouse of a veteran, or if you're a veteran receiving a retirement. This is something that you want to know to bring up to your lender, because you could have a very good lender, but they do a lot of different loan products. And so they might not think to ask, are you disabled, or are you the spouse of a veteran, or are you receiving veteran retirement? It's not always applied, and not every veteran qualifies for it. So it's something that if you do qualify, you want to bring it up, or ask if you qualify for it. This is going to waive the funding fee, so it could save you $5,000 just by bringing it up. Now, the other thing is that in certain states, if you're a disabled veteran, you could have your property taxes waived for the life of the loan. That means every year that property taxes are due, they're not due for you if you're a disabled veteran. Every state doesn't have this. Certain states do. Here in Michigan, where I'm at, we have that. And again, I think you have to be like 80% disabled. I would have to double check on it. But that allows you to waive the property taxes, and as long as you have a VA loan, or as long as you're classified as a disabled veteran, you don't have to pay property taxes. So that's another thing that could save you a bunch of money that you want to bring up, or at least Google search whether or not your state or your county allows that. All right, so last but certainly not least is talking about credit and income. So first, credit. The VA doesn't require a minimum credit score, which means that you can have good credit, bad credit, no credit, doesn't matter. The VA doesn't care. Now, on the flip side, however, the lender is going to care. So if you call me up and you're like, hey, Ben, I've got a 550 credit score and I want to get pre-approved for a mortgage, a VA mortgage. And I'm like, you know what, Billy, I'd really love to help you out, but our minimum's a 600. So there's really not anything I can do for you. Don't be discouraged. That doesn't mean that you can't qualify for a mortgage or a VA mortgage. It means that I couldn't help you out. Every lender is going to have a different minimum. So you could go out and find a lender, and it's very common to qualify you for a loan based in your credit score. Again, most lenders are going to have a minimum. Those minimums are usually going to be between 550 and about 660. But if my math's correct, that's about 90 points. And so if you're at, say, a 570, I have a 600, It just means that you have to go find a lender that has a 570 minimum requirement. As a credit side note though, having a credit score under 740 is going to negatively impact your interest rate. This applies to credit cards, car loans, personal loans, mortgages. Really having under a 740 credit score, you're going to see a slightly higher interest rate depending on what you're actually applying for. Having a 600 or under is probably going to disqualify you from most traditional loan types, including personal loans, credit cards. Generally, if you have under a 600, it's going to be very hard to qualify for those. The VA loan is one of the only exceptions where having under a 600 credit score, you could still find a lender that can help qualify you. And then having over a 740 credit score is really just kind of bragging rights. For most things, save for certain credit cards, certain high-end credit cards, having a 740 credit score, you're going to get the best interest rate or the best credit card rate for having over a 740. So when people say you need an 800 credit score, it's really not true for most things. You're going to be able to qualify with a 740 or above, or with a 600 or above, and certainly with a 740 and above. All right, so the next piece, and certainly one of the most important, is income. Now, I'm going to give you a couple figures here, and these are the things that lenders are going to look at. And I don't want to let it discourage you or intimidate you because it's really not all that complicated. And there's a couple things that you can calculate on your own. This is going to allow you to determine what type of house or how much house you can afford, because the number that you come up with is going to be different than the lender's number. And the lender's number is generally going to be the max possible that you can qualify for, but that's not really going to be financially beneficial for you to qualify for that. It's going to make you what's called house poor. And so we'll go through that in just a second. And so there's a term called debt to income. And on a VA loan, you can usually go up to 41% of your income going towards debt. And that includes the house payment that you're qualifying for now. So for instance, let's say you make $10,000 a month. You could qualify for all of your debts. These are things that are reported on your credit report, not necessarily utility bills or anything like that. It's going to be like credit cards, car loans, personal loans, mortgages, things like that. Things that report on your credit report. You could go up to 4,100% or $4,100, not 4,100%, $4,100 of that $10,000 figure could go towards debt and you could qualify for a home. So let's get slightly nerdy about this. Let's say in our instance that you make 10 grand a month and you have $2,000 worth of car loans, credit card debt, other things like that. You could potentially qualify for a $2,100 mortgage payment. Now that mortgage payment is going to have to include your taxes and insurance. So you could do a quick calculation on your own before you talk to a lender, and that's going to give you a good idea of what they're going to be able to qualify you for. You could go on bankrate.com or type in a mortgage calculator and play around with the figures to give you a good idea or indication on how much house you're going to get pre-qualified for. Again, it's not to scare you. You don't have to do it ahead of time, but you could run some of these figures to let you know what to expect before you start hunting for a home. Now, here's the very important piece though, guys. The $10,000 a month figure is, or your income figure that the lenders use, is going to be what's called pre-tax. That means that it's before you pay taxes, before you pay medical insurance. The number that they qualify you for isn't your take-home pay. It's not the money that you see going into your bank account every month. So they're going to use 41% of your pre-tax income. That is really going to set you up for a house that you can't afford. So for instance, using our 10 grand a month figure, let's say you pay 33% taxes. Your take-home pay is going to be $6,700 a month. If you make $6,700 a month, but $4,100 of it goes towards your debts, including your home, you're not going to be able to afford to invest. You're not going to be able to afford like utility bills, a new car repairs, an emergency fund. The lender doesn't necessarily take all of those into account. And so running some numbers for yourself, here's a good rule of thumb. 25 to 35% of your income, take home, the bottom, your net pay, that's what you want to use for a house payment or for your debts. So in our 10 grand figure, let's say we paid 33% taxes, you're going to do $6,700 a month. Let's say you want to shop for a home, 25% of that. That means that your home payment could be about $1,600 a month. You could determine whether or not you want to include taxes and insurance in that. It kind of depends on your income bracket, how many other expenses you have, how expensive your property taxes are. But you can determine whether or not you want that $1,600 to include taxes and insurance. But that's a better rule for you to use that's going to allow you to not be house poor and to be able to have money for other things like, again, investments, emergency funds, having fun, being able to eat. I mean, that's always important, right? If you use the 25 to 35% rule, it's just going to be able to allow you to do the things that you want to do and not live paycheck to paycheck and be able to actually enjoy your home instead of having to worry about what's going to happen next. It's going to allow you to set you and your family up for a more successful, happy future in that home. And so you want to bring this up to your lender. Ask them how they're calculating your income, or if you've calculated it yourself using the 25% rule, tell them, I don't want a house payment over X amount. Again, it's going to depend on how much other debt you have, because even that, let's say that $1,600 amount, if you have a bunch of other debt, you might not even qualify for that. But have the conversation with your lender. These are common questions, common concerns, but most lenders aren't going to bring it up, because if you're not concerned about it, then they're not necessarily concerned about it. And it's not really our place as lenders to tell you what you can or cannot qualify, or what you can or cannot feel comfortable with qualifying for. It's up to you as the customer to make that decision and determine what you feel comfortable with, so long as, obviously, you know, if my pre-qual says that you're pre-qualified for $1 million, that doesn't necessarily mean that you're going to be comfortable with that or that you actually want to make that mortgage payment. Because once the loan closes, I don't have anything to deal with it. It's up to you to make that monthly payment every month, and maybe you have other goals. Maybe you want to buy investment properties, or save a bunch of money towards retirement, which obviously I recommend both of those. And finally, to wrap all the income section together, here is the information that you're going to need to bring with you or to have prepared. So if you're a W-2 employee, meaning if you work at like Amazon, Walmart, if you're a standard employee, you're not self-employed, you're going to want to be able to bring in 2 years of your W-2s. And then you're also going to want to be able to bring in at least a month. Usually it could be a week, but usually it's about a month's recent pay stubs. And then you're going to want to be able to bring in 2 months bank statements to show that you have any funds that if you need to use funds to close, you're going to want to be able to prove that you have those ahead of time. That way you don't run into any issues. And if you don't have any funds and you still need to bring in money, you could talk to your lender about doing a gift, like a relative could lend you or gift you the money, or tell them, or you could discuss with your lender where you're getting your money from, unless the sellers are paying for it. Because there's strict rules about taking out loans, borrowing against credit cards. Cash, you usually can't use cash. And so you want to discuss in advance where your money is going to come from if you need any money. So that way you know that you have it all set up in what they call seasoned, and that way you're not going to run into any issues later on. And so if you're self-employed, if you're an independent contractor, if you're on Social Security or disability, you're going to want to have 2 years recent tax returns prepared. And then you're going to want to have any 1099s, Social Security or disability awards letters. Your lender might not need these right away. You just want to have these prepared in case they ask for them, because they almost certainly at some point during the process are going to ask for them. And so you can have these things prepared to prevent any lengthy delays. Getting an awards letter or a 1099 or a disability letter from the VA can take a few weeks. And on a mortgage purchase, we're usually working on a 30-day timeline. So if we have to delay a couple weeks because you don't have a 1099 or an awards letter handy, it can really make all the parties mad. And in some cases, the sellers could end up backing out of the deal because it's taking too long. And so you want to have these things prepared ahead of time. You don't need it before you talk to a lender, but certainly before you apply for a mortgage. The lender is basically just looking for, is your income stable and is it likely to continue? Having tax returns or W-2s aren't guaranteed that your income's likely to continue. We have people quit their job during the mortgage process all the time. But as a lender, we want to make sure that you're able to make the payment month on month and that you have stable income. All right, guys, I've had my say. Now it's time for you to have yours. Comment down below. Is there anything I missed? Do you have other questions or concerns, or do you want more information about buying rental real estate or VA loans? Comment down below and let me know. Or if you just have more information to input into the conversation that could potentially help other viewers, please comment down below. And again, as always, any additional information or resources are always in the description down below. And guys, if you got any value out of this, please consider liking and subscribing. It helps the YouTube algorithm show this channel to more people that might find value in it. So please consider doing that, and we'll see you on the next one.